Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we are going to learn a concept which is known as internal versus external financing. We're going to see some of the top 7 differences. And let's understand this concept in a detailed fashion. Now, remember one thing, to perpetuate a business, they need a thing called funding. Now it can be from its their own resources, or maybe can be sourced from somewhere else or the outside funding. So when a company sources funding from its own sources or the own resources, sources or resources, that is from their own assets or from their own right for you, their own assets, their own profits, uh, we would call it an internal we would call it an internal source of financing. So when a company needs a huge money and only internal sources are not enough, then they go out and take loans from the banks or the financial institutions. But that's the thing. Now, if we do a quick comparison between the two, we would see that the importance of both of them is quite similar. However, a company would get a very high leverage. I mean, they would absolutely save on taxes over here. We are talking about if it takes debt from outside, because you'll get interest as the deduction. So in this tutorial, we'll talk about both of the sources finance and do a comparative analysis of the internal versus the external financing sources. We'll first understand the inherent meaning. The finance, in case of internal, is generated within the business, as the name itself suggests that it is internal. So it is going to be generated within the business. And the finance is sourced by the outside of the business, that is the external finance. It can be a crowdsourcing fund, or maybe an equity fund or private equity fund. I mean, it can be anything, a VC or an angel, or I'll give you some of the external ones nowadays. They are really working on the most renowned one nowadays is the crowdfunding. Then we have the second is the angels. Then we have the super angels. We have accelerators. Then we have the incubators. There's third, fourth, and fifth, and then we have the sixth one as the venture capitalists, the VCs, and the seventh maybe the private equity players. So this all, there's one more, like, equity, and we call as debt. So these are the majority bifurcations that I've given, starting from the most renowned ones or the most a hot topic, to the traditional ones that I've wrote over here, as you can see. So inherent meaning, generated within the business, can be from your own sources, from your own funds, from your assets, and so on and so forth. Now, the application. Internal sources are used when the requirement of the funding is limited. Limited over here, that is, we are talking about the working capital part, or maybe for the small bridge gap that you need to do. For, you can say that that bridge is basically for the small funding that is required to operate the business. Because of some turmoil state, you need a small portion of your capital. And external sources are used when the requirement of the funding is huge. When you want to finance, like I'll say, for an example, let's say there's a company, an airline company, when they really want to buy a plane, or let's say an engine from GE, right, or some landing gears, which are the capital intensive assets, and for the same you need funding, and the funding majority they go for banks or the financial institutions. They may also go from any of this. I mean, they may ask for the incubators or the accelerators maybe sometimes, but usually they don't prefer this, because this is for the starting stage of the business. But if they require on an immediate basis, then they may probably go for this. But majority of the time it's the banks and the financial institutions. This was the application part. Limited, and it is huge. The third is the cost of capital. The cost of capital for the internal is pretty low, and here it is medium to pretty high. Now, why am I saying this? Because of the very simple reason that, internally the cost is low, because the cost will be your opportunity cost. There's nothing more than opportunity cost over here, because let's say you had a cash standing with you at 200, or let's say 100 million. In terms of cash, you are standing, you're a very great big company, you have a ton amount of cash in your pocket. So of that, let's say you need a funding of 10 million, so you're left with 90 million. out of this. So 90 million is going to be your savings, but the 10 million is the opportunity cost for you. But when we talk about the external banks and financial institutions or any one of them, they really charge a high interest rates. Probably, some may ask for the equity percentage and so on and so forth. So that's why the cost of capital here is pretty high. Over here, it's pretty low. Now, why? The idea is to limit the business within the boundary. May not, maybe not to grow so big, or maybe they really don't want to bear the cost, or they really don't want to give their equity. And over here, the idea is to expand from the local to national to global. I mean, sometimes they buy GDRs or ADRs, which is your American Depository Receipts, GDRs, that is Global Depository Receipts. If they want to go expand and reach out to the global world, then probably they need to fund them. They need funding for that. They need the large funders around. So this is the reason. I mean, to expand globally, and over here it's just limited to the scope. So there's a limit over here to the scope. There's no limit to the scope over here. Now, what is the amount source? As the name, as we discussed up till the 4 points, here the low to medium, and here is medium to high, because of the purpose. Over here, the purpose is different over here, and which defines the amount. Now, what exactly you need to give for the collateral? No collateral is required. Why would you require a collateral for your own funds? No one's going to ask you for the collateral. But when you are going for an outside investors, what we just talked about, collateral is required, especially when the amount is huge. Some may ask for the equity percentage, some may ask for an asset, some may ask for the inventory or your receivables as your collateral, some may ask for your fixed deposits as your collateral. So because your loan is too high, the amount is too high, they will absolutely ask for the huge amount, and that's the cost that you need to pay. And it's also going to be your opportunity cost. Now, what are the examples over here? Your retained earning, that is your profit and loss accounts. Whatever you have earned in terms of profits, it is transferred to your balance sheet. And the assets of the company, they do sale and lease back transaction. This assets of the company, I'll give an example. There's a airline company usually does the same thing. I mean, let's say they are owning one Boeing 777. So what they do is that they need funding for some short period of time. So what they will do is they will sell this Boeing 777 to, let's say, another vendor which is known as GE, and then they'll get money over here. Let's say they got 100 million, just a rough guess. So now the airline company got 100 million, and now the GE will again lend it back as a lease. It can be a finance lease or an operating lease, and it will be again given to that same airline company. And this is known as the sale and leaseback transaction they do sometime, so with their own assets. And equity financing, debt financing, as I told you, majority of the time over here, equity over here, they have been given as a percentage. Debt financing over here, equity, not majorly equity. Over here, it's equity, and they may or may not. So this is how the whole differentiation has been divided for internal and external financing. So I'll go with the final conclusion note that internal and externals versus the finance, they are both important. But the company should know where to use and what. See, the right approach is to use the right proportion of the internal and the external financing. If the company funds too much from its own resources, it would be very difficult for the company to expand the business. And at the same time, if the company depends too much on the external sources of finance, and the cost of capital or your working average cost of capital may be huge. And so the company needs to know how to fund their immediate or the long term requirement, because they also need to see their profits are not getting diluted because of the cost of capital or the rise in the COC. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.